Hi, my name's Adam. Welcome to the channel. Today we're going to talk about a way to add $2,000 or more to your retirement income every single year, and it's not going to cost you an extra dollar. So hang in there. I'll go through the exact example I'm talking about and how you can implement this into your financial plan and create more wealth out of stuff that you already have. Before we jump into it, if you haven't already joined our channel and subscribed to the channel, make sure to do so. Hit subscribe. We release at least 2 new videos every single week around financial, retirement, estate, and tax planning. So make sure to join the channel and to keep an eye out for future videos. If you've ever filled out a net worth statement and at the bottom it looks like a great number, maybe you're worth $1 million or $2 million on paper, but you feel like you don't have much in your savings or bank account. Well, that's a lot of us and a lot of Canadians because we've made so much money in real estate and a lot of our wealth lies in the home that we live in and the dirt that we live on. So how do we turn that dirt into retirement income, and how do we do it effectively and efficiently? In this video, I'm going to cover off a way to create more wealth with the money or the asset that you already have. Now, there's another part of this, which is if you're entering retirement and you have a lot of money sitting in equity in your home and you need more money to live off of. So you need to turn that equity into income. I'll do a future video on that where you can do, home equity line of credit, and there's ways to draw money out of your home efficiently. There's also ways that people get trapped drawing money out of their home. So I'll do a future video on that and how to do that efficiently. But today we're going to talk about maybe you're 5, 10 or more years away from retirement. You have a lot of equity in your home and you need to start getting money out of your home or building up more of a retirement nest egg versus putting more money into your home. So let's go through that example. Many of our clients that come to us are in that 45 to 60-year-old range. They've started to save up, they're starting to think about retirement, and they need a plan put in place. And we find a lot of people between that 50, 55 mark are paying off their mortgage or have paid off their mortgage. And they're transitioning from paying maybe $2,000 to $3,000 a month to a mortgage payment. That's no longer there. And now they have that free cash flow to put towards investments, whether it's an RSP or TFSA or whatever else it is. So that's what I want to look at. So let's say you're 55 years old, you're 10 years away from retirement, you've just paid off your mortgage, and now you have this free cash flow. And your mindset is, hey, let's just hammer this away towards RSP and TFSA every single month. And we'll start to build a nice nest egg, which is true, but how can we do it more efficiently, more effectively, and actually create a lot more wealth and income stream for you down the road with the same cash flow that you're currently putting out towards your savings? So my recommendation is going to catch a few of you off guard. Once you've paid down your mortgage, again, you're 55 years old, you're finally mortgage free, and you have this free cash flow. My recommendation is actually to go back and take a mortgage, okay? And the reason for that is you're going to be able to front end load your investments and continue with the same cash flow that you've been used to and that you were going to use towards investment. So let's actually run through the numbers. We'll throw this up on the screen so you can see the numbers broken down exactly as I talk about them. So let's say you're 55 and planning on retiring at 65. You just finished paying off your mortgage. It's worth $1 million. So the value of your property is $1 million and you're mortgage free. Okay. You have very small amount of RSP and no TFSA because you've been focusing on, your budget and paying down your mortgage and raising kids or whatever it may be. So, but you plan to use the next 10 years as a catch-up period. So, the next 10 years of your life, you're going to use that free cash flow that you were putting towards a mortgage, you're going to start putting towards an investment. So great idea, good way to kind of catch up near the end and create more of an income stream for you in retirement. So your current plan, you're going to invest $10,000 every year to your TFSA, and you're going to invest $15,000 a year to your RSP. Okay. Let's assume you make $125,000 annual salary and you live in BC. So your marginal tax rate, which is the amount of tax you pay on the next dollar you earn, is 40%. Okay. So your $15,000 RSP contribution is going to give you a $6,000 refund, which we're also going to put into your TFSA. So if we average a 5% rate of return, so we've been investing our $10,000 into TFSA plus the $6,000 refund. So $16,000 to TFSA, $15,000 to your RSP every single year for 10 years from 55 to 65, averaging a 5% rate of return. At 65, when you retire, you're going to have a nice little nest egg. Your TFSA has grown tax deferred and it's worth $201,000. Your RRSP has also grown tax deferred and it's worth $188,000. So that gives you total assets or investable assets of $389,000. So your catch-up plan worked to an extent. You have a nice little nest egg. If we look at this, if you're looking to draw income from age 65 to 95, this will generate over $25,000 of income every year. So, not bad. If you add that in with your CPP and OAS, probably enough to live off and, enjoy retirement. Now, of that income, so the exact income would be $25,364. Of that, 48% is taxable, okay? So when we look at the assets that you have, your TFSA was $201,000, RSP was $188,000. So the tax-free, we can actually draw income out of there on a tax-free basis. Your RSP is going to be taxable income. So we want to, calculate that in here as well. So again, of the 389, 188 is RSP, so 48% of the total assets taxable. So your after-tax income, just based on this being your only income, not including CPP and OAS, the numbers would run out similar down the road anyway. So your after-tax income, $24,687. So that would be your after-tax income with this great catch-up plan that you have. It's not a bad plan, but what about if we could keep that, essentially everything the same, cash flow the same, doesn't cost you an extra dollar, but add money to your retirement income. How do we do that? Let's go through that now. So let's take the same numbers that we had. You're 55, you're finally mortgage free, your property's worth $1 million and you need to catch up. And the idea is to use your free cash flow to catch up. So you had about $25,000 a year that you want to use towards investment. And we used that in the previous example. But what happens if we actually took out a new mortgage for you? We got $225,000 of cash in your pocket now, which creates a mortgage payment of just over $2,000, about $2,050 a month on today's rate, a bit higher than today's rate. So we know rates will probably go up, so I want to adjust for that as well. So again, a $225,000 mortgage amortized over 10 years, monthly payments are $2,050 a month. So with that $225,000, we take $151,000 and invest it into your TFSA account. So for you and your spouse, which maxed out at $75,500 in 2021. So $151,000 to your TFSA, and the remaining amount, $74,000, goes to your RSP account, okay? So we're front end loading your investments, okay? So we can allow that to compound for further years, more 10 years versus ongoing contributions. So that's kind of the benefit, and let's break down the numbers on how exactly that works. So your $74,000 to RSP is going to give you a tax refund of $24,278, okay? Then let's reinvest that back into your RSP the following year, okay? So you've made a $74,000 RSP purchase. The following year when you do your taxes, you get a refund of just over $24,000, and we put that back into your RSP to compound that even more, okay? When you do taxes the following year, you're gonna get a tax refund of $9,500, okay? So your $74,000 gave you a tax refund of $24,000. You took that and put it into an RSP again, which gave you the tax refund of $9,500. Again, this only works if you have the RSP room, but if you haven't built up your RSP room over the years, you probably have quite substantial room. So we're gonna assume between you and your spouse that you have lots of room and we can do this type of plan. And most commonly, we're able to do this type of plan with our clients. So when you get your RSP refund that final year, it'll be $9,500, and that's off the $24,000 deposit. And that $9,500 refund, we're gonna put into your TFSA. So much like the first plan, which was a catch-up plan, we're reinvesting all the RSP refunds, right? We want to take every dollar that you put in and get back out of your refund from RSP back into investment. So that's what we're doing. We're just basically turning as much tax refund as we can in this scenario. Only in the third year are we going to put that extra money into a TFSA. We're going to do 2 RSP deposits and then to a tax-free savings account. So fast forward to age 65, okay? So your cash flow out of pocket has been the same in both scenarios, okay? You're not spending more or investing more in either scenario. It's apples to apples. It's the exact same amount either way. But again, this, option number 2, we front end loaded with a mortgage. So we front end loaded your investments to allow them to compound off a larger amount sooner. So at age 65, your TFSA would be worth $259,998, so $260,000. Your RRSP would be worth $158,201. So total assets would be $418,199. And this is based off the same 5% that we used in the first scenario. So second scenario, you have total assets of $418,000. In the first scenario, it was about $390,000. So substantial, almost $30,000 more of assets. So in scenario 2, if we have assets of $418,000, this would generate income of $27,204. So substantially more than the first scenario. And again, this didn't cost you extra money. This is just reallocating in a different way, just taking a different route to get to the end result. So when we look at the taxable income on there, again, $418,000 is your total asset. The RSP was only $158,000. So the RSP was a bit lower than it was in the first scenario, giving you more TFSA, which was more tax-free income in retirement. So only 38% of your income is taxable, leaves you with taxable or after-tax income of $26,682, which is almost to the dollar, $2,000 more every single year of retirement income after tax in your pocket. Again, this strategy didn't cost you more money. Okay, all we're doing is front-end loading your investments and paying off a mortgage payment versus monthly putting into investments. Okay, this allowed you over a 10-year period, added almost $30,000 to your retirement nest egg, which equates to about $2,000 a year of extra after-tax income in your pocket for 30 years. That's substantial. So this is where financial planning really comes into play, especially as you get on, again, build up equity in your home. How do you use that equity? A lot of us see equity in our home as safe. We don't want to touch it. We would never want to take another mortgage. We've just paid off our mortgage. Why would we do that? Well, there's financial strategies that you can use that don't increase your overall risk, but do increase your overall retirement income. So, when you start sitting down with your financial planner, make sure to look at strategies like this, see if it's the right fit for you. This isn't for everyone, but again, you're not adding more risk to the overall financial plan, but we're adding a whole ton of income. So you might want to look at a strategy like this. If you fall into kind of this bucket where you have, you paid off your mortgage, you have a lot of RSP room, you haven't really utilized your TFSA, this could be a great strategy for you to build, more wealth, more income stream, and just more flexibility for you down the road as you enter retirement. So if you've implemented a plan kind of like this, or you have questions about what we're doing here, leave a comment below. Happy to help you out, answer any questions that you have, or book a call with us. We'll put a link to that below as well. So we're here to help. We can help people right across Canada. If you're not working with a financial planner and you feel like you're leaving money on the table through strategies like this, give us a call, see if it's a good fit for you, and we can look at rolling out a proper plan, financial plan, retirement plan, estate plan, and tax planning for you to make sure that you enter retirement with the most money that you can, tax efficiently, and the most income that we can possibly generate over the assets that you have. So thanks again for joining us today. We hope you enjoyed the video. If you did enjoy the video, make sure to hit the thumbs up. It really does help our videos get out to more people, and more people need to learn these tax strategies to create more wealth in retirement without spending any more money into investments or mortgage or anything else. So these strategies work. We use them with our clients. They've created more wealth for our clients. So again, hit the thumbs up, help this video get out to more people. Thanks again for joining us. We really do appreciate you watching these videos, and we hope you have a good day.